Right now, as I'm recording this, April 29th, 2026, silver is trading at 73.80 an ounce. And look, that number alone would have seemed almost science fiction just a few years ago. The market has moved, sentiment has shifted, silver has earned serious attention from serious investors. But here's the thing. I don't think most people watching silver right now fully understand what could be building beneath the surface. Not the price charts, not the technical setups. I'm talking about something structural, something that starts in the mining pits of Chile and runs all the way through China's export controls and into the global supply chain. Something just changed in the global silver supply chain, and the impact may not show up in the price data for another few months. That delay is exactly what makes it worth your time today. So stay with me, because if this story plays out the way the early indicators suggest it might, the market is going to catch up to reality fast, and the people who understood the mechanics ahead of time will be in a very different position than those who didn't. Let's get into it. Let's start with the headline, and then we'll pull back the layers. China has moved to restrict and, in certain categories, effectively ban the export of sulfuric acid to specific international markets. The restriction is tied to a broader wave of strategic resource controls that China has been rolling out over the past 18 months. We've seen it with gallium, we've seen it with germanium, we've seen it with rare earth processing materials. This is part of a consistent pattern, but sulfuric acid, that one hasn't gotten the attention it deserves, and that's the gap I want to fill today. Here's why this matters specifically for silver. Sulfuric acid is not a peripheral chemical in the mining world. It is absolutely central to the process of extracting copper, and silver is what's called a byproduct metal. Roughly 20 to 25% of all the silver produced globally every year comes out as a byproduct of copper mining. Not from dedicated silver mines, not from primary silver operations. It comes out of the same ore that's being processed for copper. And the way you process that ore, particularly in the leaching and refining stages, is with sulfuric acid. So when you restrict sulfuric acid supply to the world's biggest copper-producing regions, you're not just disrupting copper production, you are pulling at a thread that runs directly through global silver supply. Most people are looking at this as a copper story, and it is, but it's also a silver story, and almost nobody is talking about that second layer yet. Let me take a minute to explain the mechanics here, because this is where it gets important, and understanding this will make everything else in the video land correctly. Silver doesn't just come out of the ground in pure form. In primary silver mines, yes, but as I mentioned, the majority of global silver supply comes from operations where silver is essentially a passenger. It rides along in copper ore, lead ore, zinc ore, and it's separated out during the refining process. In copper mining specifically, the dominant process for low to medium grade ore is called heap leaching, followed by solvent extraction. The ore is crushed, stacked in massive piles, and then a chemical solution is applied to pull the metals out. For copper, that solution is typically sulfuric acid dissolved in water, creating what's called an acidic leach solution. Once the copper is extracted, the remaining solution, regener, the tailings, the residual material, still contains silver and other trace metals. Those go through further processing to recover the silver. Here's the critical point. Without adequate sulfuric acid supply, this entire chain slows down. You can't leach the ore efficiently. You can't move copper through the system at normal volumes. And if copper production slows, silver byproduct recovery slows proportionally. This is what makes the China export restriction so significant from a silver supply standpoint. It's not a direct attack on silver, it's a constraint on copper processing chemistry that happens to carry silver out the other end. Now, where does China's sulfuric acid actually go? The answer brings us to the most important geography in global copper production: Chile. Chile is not just a significant copper producer, it is the world's dominant copper producer, accounting for somewhere around 25 to 27% of global copper mine output depending on the year. The Atacama region, Escondida, Kawasi, these are operations of a scale that most people outside the mining industry never fully appreciate. And Chile has historically sourced a meaningful portion of its industrial sulfuric acid requirements from Asian suppliers, with China being a significant part of that picture. Now, here's where the early data gets interesting. And I want to be clear here. This is early stage data. We're reading signals, not confirmed outcomes. but the signals are worth paying attention to. According to industry reports circulating among mining sector analysts, sulfuric acid pricing in the South American copper corridor has already moved and moved significantly. We're looking at reported price increases in the range of 40 to 44% for certain supply contracts over the past 2 quarters. That kind of movement doesn't happen on speculation alone. That's real supply tightness showing up in the forward pricing. Separately, multiple Chilean mining operations have begun flagging sulfuric acid availability as a potential operational constraint for the second half of 2026. Some of these are preliminary disclosures, the kind that show up in operational risk sections of earnings calls rather than in headlines, but they're there if you're reading the right documents. And it's not just Chile. Peru, the second largest copper producer, is facing similar supply logistics. Argentina's lithium and copper operations, which also use sulfuric acid in processing, are watching this situation closely. The point is, this is not hypothetical. The supply pressure is already entering the pricing system. The question is whether it translates into actual production disruption and on what timeline. Stay with me because that timeline question is actually the most important part of this entire analysis. Here's the honest answer to why the story hasn't broken into mainstream financial media yet. The effect is lagged. Mining is not a sector where supply disruptions show up in commodity prices the following week. There are buffer inventories. There are contract stockpiles. There are 6 to 12-month forward supply agreements that operators rely on to keep operations running even when spot market conditions shift. What this means is that even if China's export restriction bites hard, starting in May, which is when it's expected to fully take effect, you will not necessarily see a silver supply number change in June or July. You might not see it in Q3 inventory reports at all, but by Q4, that's where the math starts to look different. This is the classic structure of a commodity supply shock. The cause happens months before the effect is visible in the price data, and by the time the effect is visible, the narrative has already moved and prices have already begun to reflect the new reality. Markets are forward-looking when they're paying attention. The challenge is that most participants aren't paying attention to this particular input yet. The sulfuric acid angle is technical enough that it's been confined to industry publications and mining-focused research desks rather than the mainstream financial press. That gap between what informed sector specialists know and what the broader market has priced in is where interesting situations develop. I'm not saying this is a guaranteed supply shock. I'm saying the conditions for one are assembling and the timing is specific enough that it's worth mapping out clearly. Let me walk you through the mechanics of how a bottleneck like this actually builds in a mining supply chain, because it's not linear. Stage 1 is price pressure. That's already happening. We can see it in the sulfuric acid contract pricing data coming out of South America. Miners are paying more. That affects margins before it affects volumes. Stage 2 is substitution attempts. Mining operators are not passive. When a key input gets expensive or constrained, they look for alternatives. For sulfuric acid, the alternatives are limited in the short term. You can try to source from other producers. Australia has some capacity, as do certain producers in the Middle East, but these aren't drop-in replacements at scale. They involve different logistics chains, potentially different pricing, and different supply lead times. If you're running a massive open-pit copper operation in the Atacama Desert and your asset supplier is in China, shifting to an Australian supplier is not a phone call. It's a supply chain redesign that takes months. Stage 3, and this is where it gets material for silver, is production rate adjustment. When the cost of a critical processing input rises significantly and alternatives are either unavailable or too expensive, operators begin running their leaching operations at reduced throughput. They process less ore per day. They prioritize higher grade material, and as a direct consequence, the silver byproduct recovery from those operations declines proportionally. Stage 4 is the inventory drawdown. Silver consumers, industrial users, mints, electronics manufacturers don't immediately feel this because above-ground inventories exist to buffer short-term supply disruptions. But inventory drawdowns are finite. If production doesn't recover, the drawdown accelerates. And at some point between stage 3 and stage 4, the market begins to price in the new supply reality. This is a slow-motion process, but that slowness is what makes it trackable. We're somewhere between stage 1 and stage 2 right now. The question is whether we move into stage 3 second-order effects. Most people miss this, and I think it's genuinely the most underappreciated aspect of this entire situation. Silver demand is not softening, it's accelerating. The solar industry is consuming silver at rates that were not modeled into most long-range supply forecasts from even 5 years ago. Photovoltaic cell manufacturing uses silver paste in quantities that scale directly with the build-out of global solar capacity, and that build-out is happening faster than almost any mainstream projection suggested. The EV transition is creating additional silver demand through charging infrastructure and vehicle electronics. Defense spending globally is rising, and defense electronics are silver-intensive. Medical device manufacturing, 5G infrastructure, advanced semiconductor packaging. All of these are demand pulls happening simultaneously and in the background, largely invisible to most retail investors. The silver market was already tightening before this China supply story emerged. When you layer a potential supply constraint on top of a demand picture that's already running ahead of baseline expectations, you get the conditions for what analysts call a structural imbalance, not a speculative spike. A genuine fundamental mismatch between what the ground produces and what industry needs. The second order effect that matters most here is the behavior of industrial buyers. When industrial silver consumers sense supply risk, even potential supply risk, they have a documented pattern of pulling forward purchases. They buy more than they need in the near term to protect against disruption in the medium term. This inventory building behavior by consumers can accelerate a supply tightness narrative even before actual mine production numbers decline. It becomes self-reinforcing for a period. I'm not saying that's happening now. I'm saying the conditions are present for that dynamic to emerge if the supply news continues to develop in the direction it's currently heading. Let me be direct about the market impact timeline because I think it's important to be honest about uncertainty here rather than overstate the case. Short term, the next 1 to 3 months, probably minimal direct impact on silver prices. The story hasn't broken into mainstream awareness. The supply disruption hasn't shown up in production numbers yet. The market is priced on today's reality, not the downstream consequences of a chemical supply restriction that just took effect. What you might see is positioning movement among sophisticated commodity funds and mining sector specialists who are tracking this. But retail sentiment for silver is driven by macro factors. Dollar strength, Fed policy narrative, safe haven flows, and none of those are responding to Chilean sulfuric acid pricing data right now. Medium term, 3 to N months out. This is where it gets more interesting. If stage 3 of the supply bottleneck sequence I described begins to materialize, meaning actual production rate adjustments at copper-silver mines, you'll start to see that reflected in LBMA and COMEX supply data. Silver inventory drawdowns will become visible, and when those drawdowns are visible, the narrative shifts. The narrative shift matters because silver is a relatively thin market compared to gold. It doesn't take massive capital flows to move silver. A change in the supply narrative combined with continued strong industrial demand could create meaningful price discovery in this time frame longer term, beyond 9 months. This depends almost entirely on whether the supply-side response is adequate. If Chilean and Peruvian mining operators successfully diversify their sulfuric acid supply chains and maintain production rates, the impact is limited. If they can't, or if China's restrictions expand or intensify, the structural deficit story becomes much more compelling. The honest position is that we're watching a potential supply shock that is neither confirmed nor resolved. It's forming, and the smart move is to understand the mechanics well enough to recognize the confirmation signals when they appear. Let me give you 3 distinct scenarios because I think framing this in probabilistic terms is more useful than a single prediction. Scenario 1, disruption expands. China's sulfuric acid export restrictions prove more extensive than currently understood. Alternative supply sources cannot fill the gap on the required timelines. Production rates at major copper-silver operations in South America begin declining in Q3. Silver byproduct recovery falls measurably. Above-ground inventories draw down at an accelerating rate. Industrial buyers begin pulling forward purchases. Prices respond. In this scenario, you're looking at a supply-side catalyst that the market is currently not pricing, which would represent a significant repricing event. Scenario 2, alternative supply found. The mining industry moves faster than expected to secure non-Chinese sulfuric acid supply. Producers in Australia, the Middle East, and potentially domestic South American chemical manufacturers scale up supply faster than the base case suggests. Logistics challenges prove manageable. Production rates hold. The silver byproduct impact is marginal. In this scenario, the sulfuric acid story is a short-term cost pressure on mining margins, meaningful for the miners, but not a major silver supply event. The price impact is limited. Scenario 3, Delayed and diluted impact. The most likely scenario in a world of complex supply chains is somewhere in between, but shifted in time. Disruption is real, but not immediate. Mining operators absorb the initial shock through existing inventories and partial supply diversification. The impact on silver production shows up in H1 2027 rather than H2 2026. The market eventually prices it, but the urgency of the timing narrative softens. In this scenario, the story is still important. It just plays out over a longer runway than the next 6 months. My read the probability weight right now sits somewhere between scenario 2 and scenario 3, with scenario 1 as a tail risk that deserves monitoring. But what makes this worth tracking carefully is that scenario 1, the supply disruption scenario, is not priced into silver at any level right now. The market is offering zero premium for that risk. That asymmetry is what makes this story analytically interesting. Your monitoring list. If you want to track this story as it develops, here's exactly what to watch and where to find the signals before they become mainstream news. Signal 1, Chilean and Peruvian mine operator commentary. The quarterly earnings calls and operational updates from the major copper mining operators Codelo, BHP, at Escondida, Glenore, Freeport, McMahon will contain language about input cost pressures and operational constraints. If you start hearing specific language about acid supply or acid pricing in these calls, that's a confirmation signal. These companies have disclosure obligations. They'll tell you if it's becoming material. Signal 2. COMEX silver inventory data. Track the weekly COMEX registered and eligible silver inventory levels. These are publicly available and updated regularly. A sustained drawdown trend, not a one-week blip, but a multi-month trend in registered inventory is one of the earliest market-based signals that supply is tightening at the delivery level. Signal 3. Silver lease rates. Lease rates for silver, the cost of borrowing physical silver for short-term delivery, are a sensitive early indicator of physical supply tightness. When lease rates begin rising, it indicates that physical silver is getting harder to borrow. Rising lease rates have historically preceded price moves in tight markets. Signal 4. China's official export data. China publishes monthly trade statistics that include chemical exports. If you're watching for confirmation or expansion of the sulfuric acid restriction, that's where the hard data will show up. There's typically a 1 to 2 month reporting lag, but the trend will be visible. Signal 5. South American chemical import data. Chile's Customs Service and Peru's SUNAT both publish trade data. These 5 signals collectively give you a reasonably complete early warning picture. You don't need to check them daily. A monthly review against these 5 data points will tell you whether this story is developing toward scenario 1 or fading toward scenario 2. The bigger picture. Why timing matters now. Here's what I want to leave you with before we get to the close. The most important thing about supply shocks, real ones, structural ones, is not that they're impossible to see coming. It's that they're almost always visible if you're looking at the right layer of data. The problem is that most market participants aren't looking at that layer. They're watching price charts. They're watching Fed meeting minutes. They're watching ETF flows. All of those things matter. I'm not dismissing them, but the commodity markets, specifically the silver market, have always rewarded the people who understood the physical supply chain mechanics before those mechanics showed up in the financial data. The sulfuric acid story is exactly that kind of upstream indicator. It's not in the price. It's not in the narrative. It's in the operational realities of mines in the Atacama Desert that most financial analysts will never visit and most financial journalists will never write about. But it's real. The chemical prices are moving. The procurement managers are aware. The risk disclosures are beginning to appear. The early infrastructure of a supply tightening narrative is assembling quietly, methodically in the background of a market that's currently focused on other things. And the timing matters because supply chains are slow. The decisions that will determine whether this becomes a scenario 1 event or a scenario 2 event are being made right now in Q2 of 2026. The contracts being signed or not signed, the logistics chains being established or not established, the alternative supply arrangements being secured or not secured, those decisions have a 6 to 9 month lag before their consequences show up in silver production numbers, which means the window for understanding this story clearly before it becomes obvious is right now. Not because of hype, not because of a price target, because of the mechanics of how supply chain disruptions travel through commodity markets. So let me bring this back to where we started. Silver at 7380. a market that's moved significantly. And underneath that market, a supply story that hasn't been fully told yet. China's restriction on sulfuric acid exports isn't front-page financial news. It's a technical upstream supply chain development. But technical upstream supply chain developments are exactly where commodity market opportunities tend to originate, before they become obvious, before they're priced in, before everyone's talking about them. The questions worth sitting with are straightforward. Is the sulfuric acid supply to South American copper producers tightening in a way that will eventually reduce silver byproduct output? Watch the signals I described. That answer will come from the data over the next 3 to 6 months. Is the global demand picture for silver industrial investment monetary continuing to absorb supply at the current pace or faster? The evidence on that side of the equation is already pretty clear. And is the market currently pricing any risk premium for a potential supply disruption of this nature? Based on where silver is trading today relative to the forward demand picture, the honest answer appears to be not really. That gap between the upstream supply reality and the current market price is the story. The real story here isn't what's happening today. It's what could unfold over the next 2 to 3 quarters if this supply constraint proves as durable as the early indicators suggest. That's the version of this story most people haven't read yet. And now you have. If you found this analysis useful, if you think this is the kind of research that belongs in front of more people who are watching this market, share this video with someone who's paying attention to silver. Subscribe if you want to follow these supply chain dynamics as the data develops, and drop a comment below if you want me to do a deeper dive on any specific piece of this, whether it's the Chile situation, the COMEX inventory mechanics, or the industrial demand picture. I'll be back when there's a meaningful update worth your